The entire idea is about stacking multiple things together to recognize market behavior, patterns, and exhaustion all rolled into one. The first thing I look for is a candle. So, obviously, I'm looking at this purple candle right here where the black line's at. Then I get a green candle. From there, I start going through and confirming some things. I'm looking at these dots. These dots are another form of confirmation. The dots are underneath the candles. They're not above them. When price starts to roll over to the other side, to the upside, the dots will go above it. So that's just a clue. Also, these modified MAs will move away from the candles if there's a lot of momentum. And as momentum starts to slow down, price will start to merge back into them. That gives me another clue. I also have this histogram on the chart, which is Trend Decipher. It helps me stay in the trend longer and identify pullbacks and continuations. Now I've got the bias indicator. Once these lines come down into the black solid lines here, that's a clue. We look at price and see what's going on. There's a pattern here. And what happens is, this moves down into the zone, and that's a clue to get out. So if I got in here, and this started happening, like if I got in on this candle right here, and then this started happening, I would get out because it's telling me price is probably not going to keep going. Trend Decipher might still be showing purple, like it's going to continue down, but the other indicators aren't. So I've got to make a judgment call. Down here, the exhaustion line, the black line, is close to the green line. We want it close enough. Ideally, we want it outside, but we don't always get that. So what happens? Price moves up, and then the pattern repeats itself. The channel indicator is used to filter out market noise and market chop. It also helps show the price range. Normally, I don't trade anything inside these inner bands. You can think of it like a channel within a channel. You have the two inner bands where price often wedges itself, and then you have the outer bands. The inner bands are basically the noise zone. When price is bouncing around inside this area, it's usually choppy, indecisive, and not worth taking trades. That's where you get fake pushes, tiny ranges, and a lot of back and forth movement that stops traders out. The outer bands, on the other hand, represent higher probability trade areas. When price reaches the outer bands, it tells me the market has stretched or expanded enough to create real opportunity. That's where exhaustion forms, where reversals begin, and where the risk to reward becomes much cleaner. Anything inside the inner channel is normally just chop, and that's why I avoid it. This is also part of what I'm looking at when I'm watching for clues, whether price is pushing into the outer bands or if it's still stuck inside the inner bands doing nothing. This structure helps me instantly see whether the market is giving me something worth acting on or whether it's better to sit on my hands and wait for a real setup. With the high-low indicator, there's a very consistent pattern the market repeats. Here's how it works. You'll get what I call a final high, and after that final high forms, you typically see a couple of candles stall out, fail to push any higher, and then price starts moving down. The exact same thing happens on the opposite side with a final low. Price will make a final low, you'll see a green candle form right after it, and then price begins moving up. This pattern shows up over and over again. The key is to pay attention to the wicks. Notice how price tries to break that final high, but can't. That failure is the clue that momentum is shifting, and that's what leads into the reversal.